So, and again, my name is Chris Haven. I'm just going to go over a little bit of what we covered last week, just so we can build upon that knowledge in case some of you forgot. So, excuse me. So I pulled up, this was at close, this was Neo, which we all really love right now. These were the calls, and I just put four just so you didn't get overwhelmed with a lot of numbers, because if you can see, I've added some extra stuff to it. Okay, so first, just if you remember, what is a call? A call is the right to buy a stock at a certain price at a certain date. Okay. So this, if you can see right up here, this call option, oops, that's not highlight. Let me get the highlight. This is for November 20th, 2020. So this is roughly 3 days until expiration. Okay, and just kind of going back with that, when you look at your calls, you're going to see three different price points. Okay, you're going to see your bid, your midpoint, and your ask. Okay, and so what's the difference between those? Okay, so the bid is the price of what people are willing to pay to buy it. Okay, the ask is the price of what people are willing to pay, are willing to sell it at. Okay, now why is there midpoint? Well, that's a good question. A good analogy would be if you are at a car dealership and let's just say you see a Mustang, and the price of the Mustang is $22,000. So this is example. You see I'll say a convertible red Mustang for sale, $22,000. Okay, but you say, nah, I want it for $21,000. Okay, and so you would think, okay, if you're going to negotiate, usually everyone always says, let's buy it at, let's do it in the middle. So the midpoint is between the bid and ask. Okay, now it's not always 100%, so not always 100%, but if you set your midpoint price, it will most likely fill. Okay, and I say most likely, and that's important, because sometimes depending on how that stock is moving or how the option's moving, it may not fill. So if you really want to go into it and you really want to buy it, you would do your ask. Okay, but remember, like I said last week, never buy market, because if you do market, it's going to fill your ask price. And then if you sell it, or if you're trying to sell it and you sell at market, it's going to go to the bid price. Okay, so let me just kind of go back on the market point. Is if you're selecting buy, that, remember, buying is what you're willing to pay for it, but it's going to match what your ask is. Okay, if you're going to sell it, it's going to go to what your what your bid's going to be. Okay, so now I guess I'll keep that, but I'll make it smaller. Okay, and so I'm just going by calls right now, and we'll go over puts again, but I just want to go over a little bit more of the more detailed stuff, so then we can apply everything we learned with the call to the put.
Yeah, will you go over call versus put and the difference as well?
Yes, right. Yeah. So a put, a put is the right to sell a stock at a certain price at a certain date. Okay. And so I'll put that down over here, and I'm going to highlight it just so you know the difference, okay? Because I've done it before too. I've selected I was going the wrong way because I either chose call when I meant put or put versus call. So, just be very, very careful when you're selecting these. And I'll show you kind of some of the errors people can make when they're selecting these, because depending on your brokerage and the program that you use, it can be very, it's literally a click of a button that can make the mistake.
So if I think the stock is going to go up,
Right. Yeah.
would I buy a call or would I buy a put?
Right. Okay. So if you're doing a call, that means you're bullish. Okay. Let me put that in there. That means you are bullish, which means price goes up. Okay. So the put is if you are bearish. Yep. It means the price goes down. Okay, so there's different options, and that's a pun intended. There are different options to do when you're looking at if you want to look at a stock and play on it, whether it's going down or up. Okay, so now again, going back into this, you're seeing a bunch of this stuff. So we covered the bid, the midpoint, and the ask. Now again, when we're talking about options trade at 100 shares. Okay, so let me write that down. So options trade at 100 shares per contract. Okay, so what does that mean? If you're looking at, and let's just pick the $42. So if I'm looking at NEO and I'm thinking, hey, NEO, it had a rough day today, but it's going to go up. And I think, you know what? I think it's going to go up. So I'm just going to buy a call for 42. I'm sorry. I'm going to buy one call to expire on Friday, and I have the right to buy it. So if you look at your calls, this is the price that you're selecting of the right to buy. So that means you're going to buy this stock at $42. Okay, and we'll just go to bids just for right now. Okay, so if it's the options trade at 100 shares, all of these three values right here. Hold on. It's easier when I had markers. But, so when I'm talking about these prices, it is affected by 100. Okay, and so what I mean by that is if the bid is $3.50, it is multiplied by 100. So really, the actual price that you're paying for that contract is $350. Okay, so what does that mean? Oh boy. Okay, so what that means is I paid $350 or $3.50 per share as a premium. They call it a premium. And that's to buy it at $42. So what it technically really means is, your break-even point. So again, if you remember last week, the break-even point is where does the stock have to pass to make money? Now you can make money beforehand, and I'm going to go into that. But just to give a general idea, for it to truly break even, or for you to make even a cent, you need to add the strike price, the price you want to buy at, plus the premium. Okay, so I'm going to delete this guy right here since we've seen the example. Oops. Come on. Why is it not doing that? Oh, that's why. Okay, and I'll get rid of this. Okay, so if the bid is $3.50 and my call is $42, you're going to add those two prices together. Okay, so 42 plus $3.50. You guys are so good with math and the quick maths. So 42 plus 350. Okay, that's what, 45.50 is what the stock needs to hit by November 20th to make, or to break even from everything. Okay? Now, you're thinking, oh my gosh, because now you're going to say to yourself, well, why would I even want to buy that? Because one, I had the right to buy it for $42, but now I have to pay a premium. That's why they call them premiums. You're trading a contract. So again, like I was stating last week, when you're looking at these options, you're not owning the stock. You're owning a contract. It's completely different. Okay. Now you pay the premium because someone, it's a contract. It's a way for people to make money and to lose money. There's always a winner and a loser to every trade. The extremities of how much or how little, that's why we have the market. Okay. So let's just say that NEO did not get past $42. Let's just say it hit 42, but it closed at $44. Okay, so what does that mean? That means that the option is now worthless. You lose $350. Okay, now this is what's called a weekly option. And weekly options, you can play them and you can hold them for a day and you can still make money even if it doesn't hit your break-even point. As long as if you buy a call, for this example, a call, and at the time that you buy it, it's still going up, chances are you will likely make money. Now, it's likely because there's other different things in play, and that's what we're going to go into, which are called the Greeks. But before we go further, are there any questions on that? Just about the call. Would be the expiration date, because that contract lasts until November 20th. The call price, which is 42, or your strike, and then just the bid, midpoint, ask. If there's anything, so I'll wait about 15 seconds or 20 seconds.
No questions
Nope.
in chat.
Nope.
So.
Okay. All right. Because I've got a couple monitors up, so it's hard to see everything. Okay. So I'm going to get rid of all this. Goodbye. Goodbye. Okay. Okay. Oh, so Colin asks, what if you buy a call that's lower than the current stock price? That's a great question. I'm actually going to explain that right now and why that can be beneficial. So that's perfect timing. Okay. And I swear I didn't place him in there to ask these questions. But so now these are what's called the Greeks, and that's just because they are very common math terms. Okay. So the first thing, and we talked about this last week, but I just want to go over it again. The big one is your delta, and just like in math, delta means rate of change. So if you've been if you're a math major, you know some do the triangle. they'll do the triangle. Okay. So delta, what that means is for every dollar the stock moves up in price, how the option call will change. Okay. So if I look at my delta, that's what we're focused on right now, and this is, let me highlight that a little bit differently, and that is 0.78. Oops, I'm sorry, guys. So we're looking at 0.7864. Now remember, these options are traded in contracts of 100. So when you're dealing with the numbers, okay, and some of them do show numbers, but others, there's certain ones that I'll have to show you what they truly mean. But when you're looking at bid, midpoint, ask, theta, delta, and gamma, you multiply this price by 100. Okay, so what does that mean? So if the delta is 0.7864 and NEO is currently at $42, NEO goes to $43. So how do you calculate the option? Okay, so the bid was $350 or $350. Add the delta of 0.7864. So if you do that, oh, okay. It's funny, I know advanced calculus, but arithmetic I'm really bad at, just so you know. You guys learn a little bit about me today. So $4.28, and I'm just going to round it to, let's just say 430 approx. Okay, so that means you made 80 bucks. Woohoo! All right. Okay. Now, unfortunately, if you hold it each day, something happens, and that's what's called theta decay. Okay. So theta is for every day the option is held, how much it loses in value. Okay. Now let me just highlight stuff so you can see. So delta goes with this. Theta goes with that. That's kind of hard to see. Okay. So how do I calculate that? So if let's just still stick with our $3.50. Okay. So when I look at that, I know I see my theta, let's just round it to 0.20. Okay. So what that means is if the theta is negative 0.20, then it loses $20 per day.
And just to chime in, Jason, when he asked, did the Greeks mess my ACB 7.5 call since it hit 750 today and I was still in the negative? This is going to be your answer to that.
Okay, so the theta, each day you hold something, it's going to decay. Now, the theta decay is exponential, but I won't go into that. But if you know exponential, it's kind of like if you heard, if I give you a penny for a month, would you rather take a penny and then I double it, or take $1,000,000? Well, you would know at the end if I double it if I double the initial investment and then keep matching it. So like 1 to 2 to 4 to 8, it will exponentially increase because the closer it gets to something, the more certainty we have of what that price is. Just like with last week, we were talking about the football game and the Cowboys versus the Patriots. When the Cowboys was on the 1 minute at the end, we knew almost for sure that it was going to be the Patriots were going to win. Now, when you look at the theta, this does change. There are some mathematical stuff that I just don't want to have people go a little bit more, to see the complexity with it. Okay, but now, so this is everything we covered last call. Okay, we covered what this is, or what the strike prices are, the bid, midpoint, ask, the theta, and then the delta. Okay. Now, am I forgetting anything? Do I need to go over like what strike and expiration mean, or does everyone remember what that was? Or maybe just write it again.
I was going to say, if you don't know what it is, just say something in chat.
Okay. Example of what the call means. Okay. So I buy one contract of NEO at 42, strike price of 42 at, expiring 11/20/20, okay, for $350 or $350. Okay. Now, let's go into, because there were some questions about the implied volatility. Okay. Now, this is something that can definitely change your, when you see some of the stuff, you're going to be like, oh my gosh. Now, a lot of people, some people, they do what's called earnings plays, which means they'll either buy a call or a put, and then in hopes of either if the stock's going to go up or down, or there are some different strategies if it's neutral. Okay. So let me give you an example. So we talked about NEO last week and their upcoming earnings reports. So let me just show you real quick on what this looks like. Okay, this was taken, and I know it's kind of hard, so let me, let's see, how can I do this? Let's just look at the main thing. This was NEO. Their stock price at the time was $46.59, and this was yesterday before earnings. If I wanted to buy a strike price of $46, so I'm technically what's called in the money. What's in the money? It means if I buy a contract and the contract has exceeded what the stock price is, okay? It's 46. The bid and the ask, it's hard to see, but this is $4.05 and then $4.25. So just with quick maths, if I were to do just the bid, let's just round it to $4. This needs to hit $50 for you to even break even. Okay, that's possible. When you're dealing with a stock that fluctuates with it's what's called an ADR, average daily range, if something ranges between $3 and $5 in a stock, that makes perfect sense to buy a call, because you could think, wow, if they have really good earnings, let's say they're like, okay, we're going to compete against Elon Musk. We're not going to Mars. We're going to Jupiter. We're going to Titan or Io, and we're going to mine more stuff than what Elon Musk is. And so their stock could go way past that. Okay. However, if you notice one thing, the implied volatility, or IV, 220%. Holy moly. What does that technically mean? It's a long mathematical term. I'm sorry, it's not long, but it's a bunch of variables that are calculated. So just kind of think of it this way. If you were to take your daily range of 5, let's say something trades between $5, so up $5, down $5 up for its range, this could exceed by 220%. So 220% of 5 would be roughly, be 10, 15, however you want to technically explain it, because 100% of 5, yeah, would be 5, but we're talking a multiplier factor. Okay? So if you look now, so I took this today, and I don't remember when, but if you look now, implied volatility, now it was trading lower, okay? But I know, okay, so oh, wait a second.
Somebody's off mute.
I keep getting kicked out.
Oh, okay. No worries. Okay. Now, if we just used our simple math of the theta being negative 0.56, so that means this option is going to lose $56 just if it stayed its price. Okay. And the delta, meaning whatever it changes, so if it goes down $1, it's going to lose $54. If it goes up, it's going to gain. But look what's happened. The implied volatility, 220%, that's because not the market makers, but just a lot of the big guys in general, they know that an earnings report can be a make or break for a lot of these other companies or investment companies. So you're paying like a premium on a premium. You're paying a lot more. So when you look at it for the next day, so this was at $45.90, which was close to what NEO was at, because this was 40, so it was $1. So just using basic math, technically this option, and I'll write this down, hold on, and I'll use white. So really this option, mathematically should be 4.05 minus 0.54. I'll just do 0.5, just make it easier. Minus 0.5. Why is that? Because the stock roughly went down $1, so it's going to lose $54, and it's the next day. So technically, this option, this should be $3 the next day. Okay, but it's not. Why? Because after the earnings were reported, its volatility decreased, meaning there can still be some play. It still could be volatile because some people may think, oh my gosh, the earnings went down. Maybe it's a good time to buy. Okay. My rule of thumb is if you ever want to do an earnings play, and this isn't advice, this is just what I do. My own rule is wait 1 or 2 days. Maybe do 2 weeks out. But you can do whatever you want. What's the beauty about some of these things. But if you look, this actually lost $200 instead of the 100. Implied volatility decreased 100%. Meaning after the earnings, and again, I'm using very simplistic calculations for you guys to understand. If you want to know more, you can DM me and I can show you the actual formula. And then you'll be like, okay, we'll need to break this down. But since it went down 100% more, look what's changed. Okay, delta still roughly the same. Things change on that. Okay, the theta. Okay, yeah, it's still going down. But look at the prices. Let's go at the bid. It's $2.05. Yes, this did go down. But look, it lost more, okay? So when we look at things like that, your implied volatility, that's, if you really want to put it more of a simpler way, this is the risk. Let me write that down.
Then, Chris, did you see, and I didn't bring it up very quickly, Jonah's question about the example in chat?
Okay, so in this example, if the strike hits 42, and I buy 100 shares, and I get on top of that, what if in 20 minutes or so it goes up to 25? Okay, so that's good. Okay, so in this example, so I'm gonna get rid of this stuff real quick because I'm thinking everyone can kind of see it, and I can bring it back too. So I'll just do that. Okay, so let me go to that example. So if the strikes hit 42, then okay, so you would be what's called exercising the contract. That you might want to just wait till it's past your break-even point. But generally, roughly 70-80% of option contracts, either they expire worthless. So really, when you say if some people say, "Oh, I'm a stock trader," you're not really a stock trader. You're a contract trader. And I mean, it's technically the same thing, but when you look at the scope of that, you're a contract trader within the market. Okay, you're just trading contracts for stocks. So oops, that's because it's white. So general rule of thumb, unless you are way in the money, meaning, let's say NEO is at $55. Okay. Hypothetically. And your call is for 42. Your break even is 45.50. You can hold on to that till the end of the day, until it expires. That's totally fine. Okay. But if it's close, I know I need to add that. If it's close to the break-even point, likely, but not always, take profits. Okay. How much profits? That's up to you. As a day trader, if I exceed 20%, I'm happy. And I'll just set a trailing stop. And which we can go into that another time. But basically, go ahead.
And there's a big difference between exercising and just selling the contract.
Right.
Most folks in here will just, I'll speak for Ken and I, and some of the bigger day traders, they'll just sell the contract at that point for the gain instead of exercising and then selling.
Oh boy, exercising. Oh boy, I always get exercising spelled wrong.
Horrible.
Horrible speller, guys. Doctorate in some stuff. Horrible at adding and subtracting and spelling.
EXER.
Exercise contract means you tell the broker you want to basically, you say, hey, we have this contract. Let's exercise it. Let's execute it. Okay. Or exercise. Okay. You want to buy the stocks at 42. Okay. Now this kind of goes with most people do not exercise. And I know I saw one person in our group chat a couple days ago that they actually exercised a contract prior. I think it was with AMC. And I was just confused. That's totally fine. I mean, people can do whatever they want. But generally some statistics. Okay. Oops. 70. Oh, go ahead.
And Jonah, you can technically exercise the right to buy those, and then you do buy them, and you can hold them for as
Right.
long as you humanly want.
Yes.
Contracts, however, have an expiration date.
Yeah.
So you can use that, and you can exercise it before. However, if you do exercise, you rightly own those forever.
Yeah,
However,
and that's what the benefit of options can be, is, for example, Amazon was at like $500 in 2016, $400. You could do what's called OTM, or out the money, and I bought 2018 contracts of Amazon for 1,880, and we all know what happened with Amazon, okay? And so I don't need to go any further with that. And so I could technically have exercised it and bought Amazon for my strike price, and I could hold them. And that could be good too, because if there's a stock that has dividends, and you just, instead of maybe saying, oh, I want to actually own the stock now and get dividends on it, then I would want to exercise it if it's way in the money. Most times, people will get out of these contracts because what happens is the theta that will go up, and or the stock can change. Okay. Now with this, you can see that these deltas are actually pretty high. Delta can go up to 1, and I could go into the more complex math later. But generally, after a call option is past a certain point, let me show you, for example. Yes, I know I have money due. It's because I don't have this broker anymore. Okay, so here's back at NEO. Notice the delta, it's approaching 1. Okay, some of them, I don't know why they don't just stick at 1, but basically after a call has passed a certain price point from its, I think it's from its row, then it'll just stay at 1. Okay. Now I know one person was saying, what do I do if I want to buy an option that's what's called in the money? So if I look at this, it makes mathematically sense for me. It may not for someone else, but just think about it. If you want to make a lot of money and you're very bullish on NEO, okay, when I say a lot of money, I mean if you want, you put your money in, you want it to work its magic. You don't want to settle for, I don't want $78 per stock or per dollar going up. I want it to be where, hey, if NEO's going up $15 in a day, I don't want this delta to be, it would be what, $12 or $1,200. Okay, and I got 1,200 because if it went up 15, 3/4 of 70, I'm sorry, 3/4 of 15 is 12. But I could say, hey, I'm really bullish on NEO before the earnings yesterday. I could look for a delta that is in the 0.9s. And now you may have to put more money out, but the more money you put out, obviously you can get more money in return. Now, unfortunately, for the people that bought these contracts yesterday, they paid their implied volatility price, and the earnings, it was kind of skewed. So it was trading sideways for a little bit, then it went down, then it went up, then it didn't know what it was doing. It's just flipping around. Okay. Now that's the one risk though. Okay. The big risk is if you buy one that's in the money, you just really need to know your due diligence, your research, and maybe not try one that's 3 days till expiration. Could NEO fall below $34 in 3 days? Sure, it's possible. I mean, what's it at? 45 right now? Yeah, it could go down $10. It likely won't because that would be a really large difference because it's daily trading range. But if we look for an example, just hold on one second. And I'm just showing you a daily of 1 hour. That can happen. Look right here on this chart, okay? Remember, these are bars, okay? If it's green, that means that's where this price started. That's where it closed at. This is 1 hour. But look at this range right here. This NEO traded at 54 to 42. Could it actually happen? Okay, so Colin says, so if you bought NEO at 34, you would automatically be making money until NEO sinks to 34. Okay, it would be reversed. You would be losing money, okay? Because think about it. If you bought NEO at 34, this call at 34, your bid's 11, so what's your break even? Okay, so oops, it's white again. So call of NEO at 30, what was it, 34?
4, yep.
And then premium of 11. So remember, it's times 100. So you're paying $1,100. Okay. Now, if you look at this delta, the delta was for every dollar it goes up, it's $1, or I'm sorry, it's $100. But if it goes down, same effect. It loses its value. Okay. So your break even is 45, because 34 plus 11. So if NEO was actually going down to 34, think about it this way. If you bought a contract to purchase NEO at $34, but you paid $11 per premium, would you want to exercise that contract? And it's at, let's just say, $40. That makes no sense to me, because I could just sell my options and then purchase NEO as it is, because I'm still losing money on that. Okay. Does that answer your question, Colin? So the goal, the goal is, if you want to day trade this and you think NEO's going to go up, maybe not pick this one because you're putting more money out. But let's look. Okay, I know there's a lot of numbers, but if you can see it, okay, 98, 93. This looks like a good one. Why did I say that? Okay, this is still in the 90s, but I'm only paying $8. I'm sorry, $8 per share. So I'm paying $800. Whereas if I did this one for the 1100, why would I want to spend $300 more if I'm bullish on NEO? Mathematically, that doesn't make sense. Now, could a trader want to just buy these? Sure, there's multiple different tactics, and I'll go over volume and open interest and why that can be like that, because people can fool the market. Okay, it's not technically illegal, because if someone wanted to buy a bunch of this stuff, sure, they can totally do that. Okay. Now, if the SEC gets involved and starts looking into it, and they think it's a pump and dump, then you can get in trouble. But we won't even go into any of that stuff.
And,
okay.
and a question that I was asked today that was pretty good. So say you buy a call option and you have yet to hit the break-even point. Could you sell that option at a gain before it hits the break-even?
Yes. Okay. So let's look at that mathematically. All right. So this is 1 day. All right. So NEO, what was NEO at? Let's do some hypotheticals so we can just see math terms how that works. Okay. Oops, that's too big.
And before you jump into it, I think the big call out is technically you can trade the contract for a gain before you hit that break even.
Right. What's nice about American contracts or American options, there's what's called a European option, which means you can't exercise that contract until the end of the day of the expiration. That's really, well, for Europeans, that's bad. But for Americans, you can buy and sell these contracts whenever you want. Okay. And you can exercise them whenever you want. Okay. I guess that didn't even need to bring in the European contracts, because that's when you can exercise. But you can buy and sell these contracts daily. So let's look at a hypothetical.
During the window.
Yeah, during let's just say it's tomorrow, during 11/19/2020. Okay, I buy one Neo 42 call at, let's just use the same prices here because you can see them. All right, at 350. So I spent 350. Okay, Neo jumps to 44. Okay, even though my break-even point, if you remember, I'm just going to use BE for break-even point, is 45.50. Okay, Neo jumped to 44, so that means it jumped $2. So let's do the math. My delta is 0.78, so I'm just going to round. So delta is 0.8, $2 up, so times 2. So 0.8 times 2 is 1.6. Okay, so that means this call at $3.50, just rough mathematically, okay, is $5.10 or $510. Oops, dollars. Okay, so this would be a real-time example too, because if you see here with Neo, if someone were to have bought down here a call right at, let's see, what was the minimum? $42 or 40, excuse me, $42, and your strike price was 42 or whatever price it needed, over this time frame right here, yeah, you're going to make money. But see, it went down, okay, and it went all over the place. So even if it didn't hit the strike price, well, it did, okay, but even if it didn't hit it on that same day, you've made $160 if you sold it at that time, okay. Or if I were to change it, let's do a Neo $50 call, okay. Same thing. Is Neo? I probably should have used this example instead. If Neo jumped to 44, currently bought, okay, then Neo jumped to 44, you're still making money. Did you hit your break-even point? No. Okay. Now maybe tomorrow it jumps up even more, jumps up to 48. Still at your break-even point? No. However, you will lose money because, again, remember what theta is. Theta is the amount of money you're gonna lose each day until expiration. Okay. So that means I would have lost 20. Now, could this change? Yes. Okay. These change constantly. If you guys have a broker program and you can view these option contracts literally at either market open or market close, just watch these numbers. All these numbers change very quickly. Maybe if you have what's called leaps or calls that are over 9 months, they won't technically move. They shouldn't move very fast, but these move quickly, and all this stuff moves. Okay. Now let me talk about, because I know we're getting close to 7 o'clock. Let me talk about what gamma is. Oops. Okay. And I know a lot of you have not taken calculus, but oh, go ahead.
I will say, Colin just said, is it better to buy in the money options with 1 month time frame, so let's answer that. Is it better to buy in the money options with a 1 month time frame?
Well, that's up to you, okay? Because let's just look at the example of Neo. So let me actually change this to a month out. So let's do just Christmas Eve, okay? So look at your break-even point. I'm just going by bids, all right? $45, the right to buy Neo in a month, $45, but look at your premium, $6.35. That means you need Neo to break over $51 to start making, or to break even. Now, like we were saying before on the example, can you make money while this is, excuse me, hiccuping. If let's just say Neo is at $52 and maybe it's the first week of December, yeah, this will likely go up. Why do I know that? Look at my theta. Okay, so theta, again, that's how much money is going to be lost each day. Theta is roughly 0.08 or 0.09. So that means each day it's going to lose $9. But look at my delta, $57. Okay. All right. Will theta ever be positive? No, you can't go back in time. Okay. Theta will always, and that's what you may hear some options traders call theta decay. Okay. Or IV crush, which we'll cover that a little bit. Well, I explained what IV crush looked like, but I didn't go into too much detail. Okay. But for me, that I've traded personally, is I just thought of is it realistic? So December 24th, 1 month. Well, I know a couple days ago it hit $54. So this was at 50. Technically my break even was 51 and some change. It could happen. Now it could start happening. It could go slowly. It can slowly go up. So each dollar, it's going to roughly go up $57 of this price. But now each day you hold it, you're going to lose roughly $9. Okay, so if NEO is steady at what was it, at $45, it may not have been into a good play or a good investment time. But no one has a crystal ball, so you just don't know. Okay, now if you notice, the further the higher the dollar value is, the closer your break even price to what your bid's going to be. Okay, but now let's think realistically though. Let me choose another stock, because with NEO, I honestly don't know where it's going to go. Okay, but let's just choose AT&T. All right, and let's just say December 4th. So I'm just a couple weeks out. Okay, because there was the question was, do you want to buy in the money at break even, or at the current price it is, or out the money for even more? Okay, so look at AT&T. This is December 4th, 2020, and it's currently trading at $28.62. Do you think it's realistic if AT&T, and I'll show you the chart for AT&T. Okay, so I'm going to 1 year, 1 day, and I'm just going to look at from September 29th to right now. Okay, look at its range. Its range is roughly $3. Okay, they had a dividend. Their earnings were good. This is what that is. Okay, and then I don't know what happened here. Okay. All right, but just looking at this, I know the range is between $26 and $29. So that's where you have to do some of your research on what do you think is realistic. AT&T has been around for a very, very long time. Okay, so would I want to buy a call, a right to buy AT&T at $36 in a couple of weeks? Well, that doesn't sound too smart, because even before COVID, this is the drop when COVID started getting announced and people were getting scared. Its highest was at $39. So that's more what would be a technical analysis point, because I know, AT&T, yeah, it hit $39, but a long time ago, pre-COVID. But right now you can kind of see it's just kind of trailing between $29 and $26. So that wouldn't make sense. Now, could you still make money off of this in a day? Yeah, you could. Let's take a look at the stuff. It's theta 0.004, so it's going to lose roughly 50 cents each day, but it's only going to gain $2 per point, or I'm sorry, per dollar changed. So if you wanted to day trade this, sure, you could totally do it. That's fine, because mathematically, one, you don't even have to look at the theta. You would just want to look at the delta. But there's other things to consider. It's 50 cents roughly for an options contract. It's not free like with stocks. Okay, or would you want to go to a put? That's something. So if I were to go to puts, so remember, puts are right to sell. So would I want to buy a put for $20, so the right to sell AT&T for $20, that doesn't sound mathematically right. Why? Because it's been in that range for a long time between, I'm sorry, I said 29, roughly between $30 and $26. So you have to think about it from a probability perspective. So is it realistic? So these are just things to consider, okay? So things to consider when buying an option. Is it realistic? Does the strike price make sense? Does it follow within a range of where the stock is trading? Okay. What is the IV? Implied volatility. Volatility. Dang it. Sorry, guys. All right. Roughly, if it's over 100%, that means, as like I was saying, that can fluctuate. So you're paying an extra premium on it. I wouldn't say it's advantageous, because it could be, because if something was to change all the time or to continue going up, then yes, you're going to make money. Okay, and there's more advanced trades that you can do. But remember, as I said last week, these are Chris's rules that I said no one can do. There's nothing to do. Okay, you can buy to open, sell to close. All right, and if you remember how I said it, when you buy a book, you open it to read. Smiley face. Okay, sell to close. When you sell a book, you close it to give to someone else. Okay. You cannot sell to open, buy to close. Okay? You can't do those. In advanced options trading, I'll tell you about those. Okay? So just those. Let me just, because I know we're at 7 o'clock, let me just talk real quick about choosing the stocks. The gamma is basically how the delta changes for every dollar it rises. Okay, so delta, if the best way to put it is, if you were calculus, let's just say this is your original derivative, this would be your second derivative. Okay, then the row or your third would be your jerk. Okay, and bind. Selling to open, so you would gain $70 because your credit was $80 and then you close it at 10 unless you let it expire worthless, which would mean you'd collect the whole $80. I'll go into that stuff in another trading session, but just to answer your question, Chris. So for example, if NEO is at, let's just say 42, NEO rises to 43. So mathematically, what does that look like? Okay, my gamma is 0.06. So again, it's like in hundreds. So roughly, if this goes up $1, so to 43, that means your delta was originally 0.78, but now you add 0.06 to it. So that means the new delta is 0.78. I'm just going to just keep it at that, 0.78 plus 0.6. Okay, so again, remember delta is how the price will move per dollar. So your new delta, so 0.78 plus 0.06 is 0.84. Okay, so that means once it goes up to $1 or to 43, now you're making more money. Okay, so it gets more complicated because then you're thinking, well, what strike price should I get? You know, it's really up to you on your on your risk management, if you're following it, or if you're going long term and you just set it and forget it. But when you're doing calls, that the one problem with calls and contracts is it has an expiration date. It's not like if you bought Neo at 40, it drops to 30, you can say, okay, I'll just hold it. It could go up in a year. All right. But with option contracts, that's the huge risk to it. And that's why a lot of people lose the money, because they don't understand that. They either bought a call option or a put option that's way out the money. Okay, so let me talk about what those are real quick. And again, so ITM in the money, ATM at the money, OTM out the money. Okay. All right, that's all what gamma is. Some things to look at. Okay, so this is kind of going into what should I look for? Okay, so this is where it can get very interesting. Okay, you have volume and open INT. Open INT means open interest. So I need to go over what the definitions are for those, just so you can make an idea. And it just kind of goes back into what makes sense. Okay, volume equals the amount of trades that occurred. So that means one person sold, one person bought. Okay, so an example, car. Dealership buys a car from the manufacturer. Dang it. Hold on, my mouse just went away. Uh-oh. Oh, there it is. From the manufacturer. From the car place, okay? Then sold to a customer. That is one volume, okay? Open interest is different, okay? That means the amount of options that are being held by people but not sold. Okay, so example would be dealership has 2 cars on the lot. They are trying to sell, trying to sell them, but no buyers. So that means open interest is 2. Okay, so how would you want to pick your plays, or this? It gets very complicated, because what you're doing is you need to figure out, well, what are a lot of people doing? Could there be people that are maybe buying these that are shorted, which we don't know? Okay, it's beneficial to look at both your puts and your calls. And in terms of how your broker shows that, sorry, I know Schwab, I know TD Ameritrade, I know Ken knows Webull, but those are things to look at. So when I look at, going back to Neo as our, going back to Neo, you can kind of see where is the activity happening. So the more volume, those are the trades that were actually placed. Open interest, how many people have them open trying to either sell or trying to sell them, okay, to get it closed. All right, so you can kind of look at, you can't go further, but if you just look at the puts, or I'm sorry, the calls, you can see it. But I would say look at both, because then you can kind of see where are people placing their, I almost want to say placing their bets. Okay, options are not really a gamble, but it's a higher probability to lose money if you don't know what you're doing, and you may not know the direction of the stock. Okay, and I'll go over that more in depth next time, and then we'll go into other things after that. I just wanted to give you a feeler for the volume and open interest, but so let's go with some questions.
Anyone questions? And I know we've lost a few here and there.
Yeah, over an hour, I understand, but it's really important to get these basics down before going anywhere else, because I'm not going to use the analogy that I was just thinking of, but it's dangerous to your financial or to your finances to not understand what some of these things are, and then to